I'm Pamona Sharma, the editor-in-chief of ThinkBiz, which is the official blog of Commercium, St. Xavier's College Common Society. And I'm going to be your moderator for this session. Just give me a moment, I'll share my screen. So yes, I'm extremely excited to be presenting to you on this day of Commercium's Foundation Day, a discussion on pandemic through the lens of finance, impact of COVID-19 on the banking and investment arenas. Just before beginning, let me tell my dear participants, please keep your mics turned off and your videos turned off in case you have a low bandwidth. There will be a question and answer session towards the end. So you can use the Zoom chat box and send in your questions anytime during the session. Please note that send your questions only to Q&A 1 and Q&A 2 hosts. Otherwise, we'll not be able to see it. And do not use the chat box for any other purpose apart from this, and no counter questions will be entertained. In case you have any technical glitches or you get logged out accidentally during the meeting, do put in a message in the WhatsApp group that you may have joined. And we will be sending you a feedback form towards the end of the session, after filling which you will be getting your certificates. So stick around till the end. Talking about our speaker, we have with us a very special guest, Mr. Prashant Jain, an executive director and chief investment officer at HDFC Asset Management Company Limited. He has a brilliant 27 years of experience in the field of fund management and research in the mutual fund industry. His experience with the banking sector and mutual funds makes him the best suited speaker for this session. We welcome you, sir. We are so honored to have you.
Thank you, Pamela, and pleasure being here.
We also have with us Dr. Suwaiba Pirani, who is the founder faculty of Commercium. She has more than 10 years of experience in academia. She's also the head of the commerce department for the arts section in our college. And additionally, she has authored a lot of books, modules, and research papers in the field of commerce. Welcome, ma'am.
Thank you, Pamona. A very warm welcome to our chief guest, Mr. Prashant Jain from Xavier's, and a warm welcome to all the teacher, faculty, students, and participants in this webinar. Today is a very special day, and I would like to highlight this. It is a special day for us, Team Commercium, because it's our Founders Day. And today, basically, we started our journey in 2019, and it's been a great journey altogether. So firstly, before I begin the session, I first like to congratulate our team, our student founder, Vedant Shukla, and our current chairperson, Ananya Acharya, and all the team members who were there in the journey 2019-20 and 2021. So it was a very good start, and I'm really happy and glad to continue. Let us begin our session with Mr. Prashant, sir, and let us see what is the impact of COVID on the banking and the investment arenas. Thank you so much, Pamona.
Yes, ma'am, absolutely. Without waiting another moment, let's get into our discussion for today. So I'm sure all of you will agree when I say that it has been an unbelievably amazing year so far, has it not? The whole world is experiencing uncertainty and hardship due to the COVID-19 pandemic. And moreover, it struck when the global economy was already facing a tough time. And in such difficult situations, it becomes increasingly important to not only take prudent financial actions, but also corrective decisions for one's well-being. And when it comes to asset management and investment, who can guide us better than Mr. Prashant himself? So, sir, as a starter to this discussion, we would like to know what, according to you, has been the impact of COVID on the whole investment landscape. So, considering that there are several investment avenues like debt mutual funds, equity mutual funds, bonds, debentures, etc., it becomes quite difficult, and especially at a time like this, to know where exactly is one heading into. And we get suggestions like keep it liquid or focus on short term only, when it comes to investing these days. So, what according to you, sir, is the impact of COVID on investment? And is there a way in which an ordinary investor should work around at a time like this?
Sure, Pamona, and thank you very much for making me a part of this event. And I'm extremely glad to be here and to share my thoughts with you. The question you asked, it's a very all-encompassing question, and one can speak on this for a very, very long time and still not do justice. But let me try and do the best in a few minutes. See, one, the impact of COVID will be in some areas short term, in some areas longer term, and in some areas we still don't know. We will have to figure out the answers as we go along. So if a retail shop loses business for some time, it will not make any losses. Airlines, hotels, they will suffer, we know that. So that's a short-term impact. And if you believe that life will come back to normalcy after a year or so, then the impact on the value of these businesses is likely to be quite minimal, because the loss of 1 year's profit on a business is probably equal to 5% of the intrinsic value of the business being reduced. Sometimes it could be even lower. Now, if the business is in a weak situation, that it makes so much losses that it loses market share, is not able to come back, because at times like these, the good companies, the stronger companies tend to gain market share. So it is also possible that certain weaker businesses may suffer more loss of value than the stronger businesses. Banks also and the NBFCs also will suffer some asset quality impairments, because one impact of COVID is clearly that as businesses struggle to maintain cash flows and to minimize the adverse impact on profits, they will focus significantly on trying to cut costs. And one way of cutting costs is to either reduce the headcount or to reduce the wages. Therefore, I think for some time, wages will be under considerable pressure. India is a low-income country. The income of the bottom half of the households in the country, the average income is just 25,000 rupees per month. And most of these people are employed in the services sector, like restaurants, malls, retail shops, airlines, hotels, local transport, tourism, etc. Now, when the top 20% households in the country don't step out, don't spend, it is impacting the income of this large number of people who are low income earners significantly. And therefore, I think the lower income groups who have also supported their lifestyle or needs in the last 10 odd years through small borrowings. As we know, a number of households in India have borrowed not just for homes and cars, but for a multitude of things. So I think when incomes are impacted, these loans could get impaired, and therefore it could lead to some impact on the retail portfolios of banks and NBFCs as well. Now, coming to there are certain consumer habits which we will know whether we will change for good or not, whether we will go back to malls or we will make greater use of e-commerce. To what extent and when are we comfortable entertaining people, meeting other people, going to restaurants, malls? All these are questions. How much of corporate travel is replaced by Zoom sessions or some other sessions like these? These are questions to which we don't have all the answers. So there are some impact which are short term and some impact which will be there for longer term as well. but we clearly don't have all the answers. Coming to the second question, second part of your question as to how should one invest, where should one invest? I think there are no simple answers to this. And while at times like these, a typical reaction is that run flight to safety, and people want to be liquid, and but then there is a big price that you pay for that. And let us not forget that uh, at times like these, also good bargains or good investments are available. Because whatever risks you are witnessing, I am witnessing, the whole world is aware of those risks. And the key question to ask is, how adequately are these risks priced into the markets? And what I have seen in my experience, markets tend to overreact to events like these. When the short term is very negative, markets tend to be very pessimistic, and they drive down the values of many businesses below the fair values, and therefore it could create significant opportunities for the discerning and for the long-term investor. Now, coming to the issue of equities versus bonds, I think this is not an issue that should be much impacted by COVID to my mind. Rather, it should be more impacted by your risk profile. And the way I typically answer this question is just ask yourself two questions. What is that portion of your wealth which you don't need for the next few years, and on which you can tolerate volatility both emotionally and financially? And that is your risk capital, and that is what you should invest in equities. And whatever is that portion of your wealth which you don't want to tolerate volatility on, that is your safe capital, and that should be invested in fixed income. As far as the Indian economy is concerned, I think we are relatively well placed in this environment because of the low oil prices and the low global interest rates. India needs two things from outside India. One is oil and the other is capital, and both are cheap. So that makes us reasonably, at least the external side of the economy is reasonably comfortable. Our foreign exchange reserves are touching a new high every week, and it is likely that in the current year we will have a current account or a trade surplus. What we have also experienced is that at times of crises like these, the reforms pick up pace, and many tough decisions in the past have been taken around very challenging times. So I think this government has also indicated that they are committed to reforms, and we are seeing considerable reforms in the pipeline. Some have been announced, which I think will improve the prospects of this economy going forward. And one last thing I would like to add here is one important change is taking place in the world, and that is China, which is the world's manufacturing factory. It has a very large share of global manufacturing. Their costs have been going up in the last few years, and manufacturing has been shifting out of China into other neighboring Asian countries. Because of COVID and the association of China with COVID and the overdependence of the world's supply chain in China, and there has been considerable disruptions to that. Many of the world's large buyers, the large multinationals, they want to reduce their dependence on Chinese manufacturing, and they are looking for an alternate source, and this is called a China Plus One strategy. I think India has a fair chance of getting a share of that manufacturing which will move out of China. And also around the same time, the developments on the Indo-China border have given a sense of urgency to this country to indigenize more, to reduce our reliance on imports, And I think we are seeing a number of steps being taken by the government to encourage local manufacturing. So I think given the favorable regulatory environment, the rising costs of China, and also the increasing desire of the multinational companies to reduce their over dependence on Chinese manufacturing, I think opens a very interesting and a very large opportunity for India's manufacturing. As you know, India is a global leader in services, but we have a long way to go in manufacturing. So I think this is a very interesting, very large opportunity, and I feel optimistic that this will improve the growth prospects of India going forward. Yes. So Pamona, that was a very long answer to a very brief question of yours.
No, sir, I completely get it. So with your permission, sir, I'd like to move on to the next point of our discussion. So one of the sectors that has been impacted, along with, of course, tourism and hospitality, is also the housing sector, which has usually faced the brunt of COVID. So people say that there has been a reality check on the real estate prices in India. The demand has fallen. People are investing lesser in equities in real estate business, and banks have become quite cautious while lending for the fear of a default. And very recently, Mr. Narayan Murthy said that if the pandemic continues, then the work from home might become a new norm. So we don't know when the buyers will be back in this section. So, sir, do you think that this is only some kind of a time correction phase that the real estate is going through? And what kind of a decision would it be to invest in this sector, maybe now when the prices are so low?
So Pamona, I am not an expert on the real estate sector, but let me do my best and share some thoughts with you and your colleagues and friends. See, real estate is in two parts. One is commercial real estate, the retail shops, the malls, the offices, and the residential real estate. And I think there are two or three moving parts here. One is clearly the demand for office real estate, commercial real estate may be weak in the foreseeable future because retail shops will have less business and therefore rents are likely to be negotiated lower, and some retailers may even shut business. If the trend of working from home sustains, clearly longer term it will lead to lower demand for commercial space. And Google has said, I think 50 to 75% of the workforce will work from home for the foreseeable future. TCS chairman has said in the next 5 years, they expect 50 to 75% of employees to work from home. So clearly these are trends that will reduce demand for real estate. The flip side of the argument is that in a growing economy, this will pass, and over time, once the adverse impact of this lower demand is absorbed, the demand should again start growing. And because of the current conditions, the new supply that will come to the market is also likely to be very restricted, because a developer will also think like this, that if I develop something today, who is going to buy and what will be my realization? So I do agree with you that the near-term outlook is challenging for this sector. But again, if someone is going to invest in real estate, one has to think 5 and 10 years. And the answer to that, in the answer to that, you also have to consider that how will the supply change going forward. I think when it comes to residential real estate, there is a huge demand in India. As you know, most Indians, they have very small houses and they stay very far off from the places of work. So I think the demand for residential real estate is constrained by affordability. And I think given the way interest rates have moved in India, 4 or 5 years back, the home loan rates were about 11%, and today a home loan can be accessed at 7 or slightly below 7%. So that means that the EMIs on home loans have dropped by 30 to 40%. On top of that, real estate prices have moved lower, and to that extent, the affordability of real estate has improved. Again, as I said, wages are also under pressure, especially post COVID. And therefore, as you can appreciate, there are many moving parts to this issue: wages, lower interest rates, latent demand, desire to move into bigger houses, etc. So I don't think I have a clear answer, and I don't think many would be able to provide a clear answer also. But we may want to consider two more factors. One is real estate can be fairly localized. Real estate prices can be fairly localized. If you look at Mumbai itself, if you go back 30 years, the prices in Nariman Point have not done well at all for 30 years. But in the same city, if you look at the suburbs, prices have moved up very sharply, sometimes as high as 5 to 10 times in the same city. BKC as a commercial center, prices have done much better than Nariman Point. So I don't think real estate is one monolith, and you can say real estate will do well or not do well. There can be significant variations across cities, and sometimes, as I just mentioned to you, even within the same city. One more parameter which I think is very important and relevant here, and I track this, is the gap between mortgage rates and the rental yields. So many of you may not be aware, or you may not believe this, but in 2005 in Mumbai city, the rental yields on residential property were same as the mortgage yields. So rental yields in across the city were around 7, 8 or 9, 10%, and that was the mortgage rate. So if you moved out from a rented premises to a own premises, your EMI was quite close to the rent that you were paying. So that was an indicator that real estate was very affordable. Now, a few years back, the rental yields were 2% and the mortgage rates were 10%. So that meant that the EMI on a house was 5 times the rent, and therefore real estate was less affordable, and that is probably one reason why real estate has not been doing well. Now, where are we today? Today, as I said, the mortgage rates have come down to 7 odd percent, and rental yields, because property prices have come down, I mean, they could vary from location to location, but I think they could be around 3 to 4%. So you can see that the gap between rental yields and mortgage yields has been narrowing. So I would say, based on my very limited understanding of the subject, I would say, in very general terms, real estate near term appears to be challenging, but longer term, I think it would depend on how this economy behaves, how the incomes behave, how the supply side behaves. But I would look at this matrix of rental yield versus mortgage yield as a guide to decision making.
Yes, sir. So the next question that I have, sir, is about gold. So as we have seen, we can say there's almost zero demand for gold amid COVID-19, but the prices of gold are skyrocketing. And this is maybe because the investors consider it as a safe haven, and it is an effective tool to hedge against inflation and other economic uncertainties. But apart from these reasons, sir, do you think that there could be any other reason that drives the price of this metal? And do you think that investment in gold, in less riskier assets like gold, is always a best option, and especially at a time like this?
See, uh, there is again no clear answer to this. What is the definition of risk? That itself is debatable. Uh, is volatility of near-term prices your definition of risk, or low returns over long periods? Uh, that is your definition of risk. So I don't think uh, there are very clear answers to this, but let me try and address this issue the best I can. See, gold is an asset which has preserved purchasing power over very long periods. And in some cases, people debate that also, but by and large, that is what is the accepted view, that gold is a good reservoir of wealth. It will not increase your purchasing power, but it will not reduce your purchasing power also over long periods. Gold is also an asset which has very long cycles. So gold prices may not do anything for 10 years or longer, and then suddenly they may do extremely well, like what we are experiencing now. Gold is also an asset class which does extremely well in crisis type of situations. So if you are in an environment, or if you are in a country where there is economic uncertainty, there are law and order challenges, the value of physical assets, I mean real estate, etc., or financial assets is at risk because of the, let's say you were in a country like Afghanistan or Syria or Lebanon, where there is a lot of pain socially, economically, politically. In such an environment, most assets would lose value, be it real estate or financial assets. But gold would hold on to value because it's a global asset, and whatever your currency depreciates, it will make up for that. I think in India that is not applicable because we are a very stable country economically, politically, and even socially. So I think when it comes to taking a view on gold in India, we have to focus on the dollar price of gold. And I think there again, the recent rally has been driven by the very high amounts of liquidity that the world has, and also the nearly zero interest rates that a large parts of the world is experiencing. As you are probably aware, and I could be slightly wrong here, about 60 to 70 trillion, people say, dollars are earning negative yields, negative rates. So if you don't want to invest in equities because they are quite volatile and they are a very different asset class, and bonds are earning you zero or negative, what do? A part of this money will say, let me go and buy gold, because gold, at least over longer periods, gives me inflation linked returns. So I think that is what is happening, what has driven up the price of gold. Now, what is the view from here? I don't think the answers are very clear. And this is true for in financial services, in investing quite often. You will appreciate that for every share, for every investment that trades, that you buy, there is a seller. So unless two people think exactly opposite about the same asset at the same price at the same time, that asset will not trade. So, and that's why I think opinions are different on gold also, but let me share with you what the arguments are. And I don't think I will have a clear view on which direction gold is going to move from here. I think the key variables to monitor are interest rates and inflation. If you believe that interest rates are nearly zero and they will go up at some point of time, inflation has been extremely low over last few many years, and China was a big force in that. because of Chinese costs, the manufactured prices kept on coming down, and that kept inflation low. Now, because of the changes taking place in the world, uh, is inflation going to come back? Are interest rates, can they go back up? If the answer to these two is yes, if interest rates go up, it is not good for gold. If inflation goes up, it could be good for gold because gold is a hedge against inflation. But I don't think me, or for that matter, even other experts, will be able to give you a definitive answer. And if you look at the expert opinion also, it is quite varying. But I would say the way I look at gold personally is look upon gold as an insurance and don't look upon gold as an investment, especially in India because our macroeconomic parameters are stable and our interest rates are not zero. You can earn 4, 5, 6, 7, 8% on fixed income depending on what fixed income assets you are willing to buy. But we should hold some insurance, look upon gold as an insurance, and so I think 2, 3, 5%, 10% allocation to gold by a household is good because it will help you, it will work for you on the day when everything else fails. We hope that that day never comes because you don't want to be in a situation where 90% of your assets are not doing well. So I think look upon gold as an insurance, look upon it as a very, very long-term asset and 5-10% of one's wealth. I think gold is a good idea. And if you are buying gold in India, I think buying the RBI gold bonds is a better option because gold does not give you any coupon. But if you buy these gold bonds, they will give you 2% interest rates. And you also help your country by saving precious foreign exchange. Yes.
Yes, sir. So, moving on, the next question that I have is about banks. So, as we know that our finance minister, Ms. Nirmala Sitharaman, has announced the emergency credit line guarantee scheme, which is worth rupees 3 lakh crores for the MSME sector that has particularly faced the brunt of COVID-19. So they are saying that you should lend without a fear and give guarantee-free loans. But as we have seen, the bad debt problem of Indian banks has only been increasing, leading to more and more non-performing assets. So, do you think, sir, we need a little bit of minimalization of the government interventions that have risen due to the pandemic on these banks? Can the banks actually lend fearlessly because the government is giving a guarantee now? And in this context, sir, what do you think about the banking scenario today?
See, I think your chart has data till March 19.
Yes, sir.
So, and you can see the NPAs are now lower than where they were 3 or 4 years back. And if you update this for March 20, I think it would show a further small improvement. So I think it is right that over the last several years, we did have an asset quality challenge. As you can see, between 2009 till 2000, post 2009, NPAs have gone up. There is no denying that. But I would say the probably the worst of the bad loans are behind us. That is what is my sense. And see, in the last cycle, we saw significant bad loans from the companies. But the corporate leverage in India has moved down significantly. And many of these loans have been provided for. And many companies have also changed hands. And State Bank declared the results 2 days back. And they are 1/4 of India's banking system. And they did say on the results call that the current year should be a better year than last year in most respects. See, COVID-19 will lead to asset quality challenges for sure. But I think the challenges will come in two parts. One is the small retail loans, the consumption loans that have grown sharply in the last 5-10 years. So they could come under pressure. And also because of the economic slowdown, the cash flows being under pressure, the small medium enterprises, they could be severely under pressure. Now, as far as the small retail loans are concerned, large banks have a very small share of their balance sheet in such loans. The retail loans of the banks mainly comprise of mortgages and automobile loans. And the profile of the bank's customers, at least the large bank's customer, is quite superior to the smaller banks and to the NBFCs. So I think the impact on retail loans asset quality of large banks, to my mind, is likely to be quite moderate and manageable. As far as the MSME loans are concerned, you are right that government has given 15 to 20% incremental. They have facilitated incremental 15 to 20% loans to them by the banks, and these are guaranteed by the government. Now time will tell how these loans behave, because I think a 15-20% extra loan gives you enough cash for a SME or a MSME to do well or to survive at least for 1 year. Now, how the economy behaves after 1 year and what is the state of these SMEs, the MSMEs, I think the pain on asset quality from this on this front we will know only after a year. But I would say, in summary, the pain of asset quality will not be uniform across banks and NBFCs. The larger banks, I think, are reasonably well placed. It is the smaller banks who have a much higher portion of their balance sheets to these vulnerable segments, and some NBFCs where very large exposures are to these two vulnerable segments. I think they could experience meaningful pain, but large banks, to my mind, are quite okay. But yes, clearly, it is very clear that current year, some banks will experience a higher provisioning cost, and they will also experience a moderation in profits. But by and large, I think we should come out quite.
Yes, sir. So let's talk a little bit about the stock market now. So with the economy in a free fall and the high volatility of the market around this time, there are a lot of sectors that have fallen flat, but there are also sectors like FMCG and pharma that have benefited so much that they are anticipating a rally. So with variations like that in the same marketplace, the sectors which are worst hit, like retail and financials and aviation, do you think, sir, will ever pick up soon? And what, according to you, might be some lessons that the investors should have learned by now from this situation and perhaps could apply in the future while trading on the stock market?
So I think let me come to the investing lessons first, because that is simpler to answer. See, one lesson you can learn from this is that the Black Swan events or the Six Sigma events are a reality. So, I mean, sometimes the most unanticipated risks can attach themselves, they can manifest. So, when you are investing, you should be prepared for such events. They may take place once in 50 years, but we don't know what is that time. So don't take risks which where you cannot handle the downside. And let me narrate a small fictitious story which I read, and I read this in a book by Howard Marks. He is an extremely talented, gifted, successful investor, widely followed by people like me. So he said that his father narrated this story to him, that his father went to a race, horse race, and there was only one horse in that race. And for some reason, none of the other horses showed up. So there was this person in that horse race who bet all his life savings on that horse, thinking that this is a great, success is guaranteed because there's just one horse and it has to win. But as luck would have it, that horse did not complete the race. It jumped the fence and ran away. So I think this is a fictitious story in all likelihood, but it does tell us that don't put all your eggs in one basket. And risk can be very less probable. It can be very unlikely, but such events can take place once in a while. So I think asset allocation is extremely important when it comes to investing. And that is what I said earlier. Only that portion of your wealth which you don't need for 3-5 years, which you can tolerate volatility both emotionally and financially, you should invest in equities, and the balance should be invested in assets like fixed income. So I think that is one lesson what all of us can take. And of course, what this also implies is that we should never borrow and invest in equities. And we should also not participate in most cases in futures and options, because futures and options are nothing but some kind of a leverage. Now, coming to the earlier question on sectors, see, this is a question on which opinion would vary from individual to individual. And as I said, every share that trades every single day has a buyer and has a seller. And the buyer and the seller think exactly opposite for the same company, same time, same price, same everything. So I think it is two people are taking a different view of the same business and of the future. But if you ask me, and this is my personal opinion, see, sectors like FMCG and pharmaceuticals will not get impacted much by COVID. That is known to everyone. Whereas tourism, hospitality, retail, aviation, they will have a very challenging near term. That is also known to everyone. Therefore, pharmaceuticals and FMCG companies have done quite well on the stock markets, and tourism, retail, aviation, they have not done well. This does not mean that you should simply go and buy FMCG and pharma companies and not buy tourism, retail or aviation. And I don't think the answer to that is clear. What one has to take a view as to how will these businesses look after 2 or 3 years. When COVID will pass, when headlines will change, when life comes back to near normalcy, how will these sectors do after some time? And in relation to that assessment, what will be the performance of these sectors after a few years? What are the valuations today? So that is the key question to be answered, and that depends on what view people take from across these businesses. And the answers to these businesses are never definitive, and they are also in the nature of individual opinions and views, and only some of these views turn out to be right and some turn out to be wrong. But you are students of commerce and finance, so I would leave that part to you.
Yes, sir. I'm sure that the participants are very eager to ask questions to you. So I would just summarize whatever we have had up till now. So we've talked a lot about the pandemic situation, but sir, in your judgment and in your opinion, like whatever you think would be broadly, very broadly, the scene of investment and all these sectors that we have discussed up till now, where would they be in a post-pandemic situation? And what would you like to give as a word of advice, or maybe a lesson learned that you might have learned through your experience uh, with young investors like us?
See, I am an optimist by nature, and optimist means, I feel that COVID will pass, and we will figure out a way to either live with this or to solve this, and someday even a vaccine will come. So life should come back to a reasonable degree of normalcy in the foreseeable future. How long it takes, I don't think anyone can give a clear answer, but that is my point of view. So I would uh, look. I would expect people to start traveling again. I would expect people to start shopping again, start flying again, and of course, a share of some habits could change for good, like the share of e-commerce. Sitting at home, you may buy a couple of things. So I think those things will change for good. So I would say I would look for these businesses which are adversely impacted due to COVID. Uh, I would look upon them positively, because if a business can survive these tough times, if a business is strong enough to survive these tough times, it is also likely that they will gain share in the marketplace at times like these, because many weaker players would either shut down or they would lose share. So the strong companies would get stronger in the respective industries. And I have also experienced that the best investments are often made in the most difficult times. And why does that happen? It happens because the human mind, it always gives more importance to the recent developments. And the markets and many of us are always overreacting. After a risk has attached itself, people run for safety. And if the last few years have been extremely good, people go and buy very expensive assets. There is a tendency to chase prices, to participate in momentum, both on the way up and on the way down. And therefore, at times like these, when there are a lot of challenges, when near-term profits are very weak, either people don't think long-term, or they are too obsessed with the near-term risks, and this drives down prices of businesses to below fair value levels. So I would say, uh, over time, the businesses which are impacted today more by COVID, assuming that at least 90% of consumer behavior comes back whenever COVID normalizes, I think the businesses which will gain share in these spaces should do quite well. But see, again, it is very hard to answer questions like these, because the answers to these would vary from individual to individual. And even views of a person like me, it could change over the next few months, or as we think more, as we are faced with more data. And that's why I think investing is both very interesting and a very challenging business.
Sir, and some advice for student investors like us?
Spend less, save more.
Yes.
You spend what you don't spend what you can spend. Spend what you need to spend. And a rupee saved is a rupee earned. And a rupee saved can become 10 rupees in 10 or 20 years if you invest wisely. So spend conservatively, and don't borrow for your investments. I see people buying mobile phones on EMIs. It is, to my mind, not the right thing to do, because a mobile phone or stuff like that, these are depreciating assets. And when you borrow against a depreciating asset, it is never a wise thing to do. So stay within your means, whatever resources you have, stay within them, spend less, don't come under peer pressure. Develop a second source of income, and I think investments can be a good second source of income. And you are young, all of you, so you have a very long working investing career ahead of you. So I think people like you should generally invest more in equities, because it has been proven time and again that equities over long periods tend to outperform most other asset classes, whether it is gold or fixed income. So equities outperform by a very handsome margin. And if you are investing on your own, be careful, start with very small amounts. You may initially get lucky, and I have seen that. You may call it beginner's luck, and that gives overconfidence to people and they invest very large amounts. So don't do that. In investing, one cycle is 8 to 10 years. So assess your capabilities very carefully, and unless you are very sure, you may want to invest your savings in other with others, like in mutual funds, and you could choose either active funds or passively managed funds.
Thank you, sir. I really hope that we'll be able to practice that. It's a good time to start the Q&A now. Shreyas, can you please take it forward? I now open the ground for the Q&A.
Thank you, Pamuna, and a very good evening to all. My name is Shreyas Gaisas, and I'll be handling the Q&A session. Sir, we have received a few questions, and I'm sure all of us are very eager to seek your inputs on those. So going to the first question is, during such times when the companies are worried about going for an IPO, fearing that it might not go well, Jio has attracted huge investments, and Reliance Industries has announced that it has become debt-free. So do you think that it is the right time to go for IPOs, since most of the companies are hesitant and accompanied by the fact that the market is trading at a discount due to the pandemic, causing investors to look for good avenues to invest?
See, I think if you look at the markets, actually they have done quite well. And most people are wondering that how can the stock markets do so well when the economy is so much of pain? I think the answer to that is that the share of consumption in the economy is almost 60 to 65%. But the share of consumption in the stock markets is just about 20%. And you mentioned Reliance. Reliance is a refining petchem company. It also has a very successful telecom business. And it is also a force to reckon with now in retailing. You also have to consider that the interest rates globally are extremely low. And India is a very sought after investment destination, because India has one of the best demographics in the world and it offers immense growth opportunities. So I think there is no absolute answer, right or wrong answer to the question. I think this market has enough depth, and the globally there is enough capital available for companies that inspire confidence, and as Reliance shows. But for companies which are weak, I think this may not be a great market to access the markets. So I would say this is a good market for strong companies, well-managed companies. There is reasonable liquidity. There is no challenge. But these are not markets where anything and everything would be.
Right. Thank you for your input, sir. Moving to the second question. The second question is, the stock market saw a bloodbath with the advent of COVID-19, but within a matter of few days, majority of the markets started to rebound across the world and are now racing to reach new heights. On the other hand, the pandemic is tightening its grip. Do you think a bubble burst is on its way, given the fact that the markets are performing in a contradictory manner when compared to the economic condition of countries?
So I think this is a very pertinent question, and this is a very commonly held concern, that when the economy is in pain, how could the markets be doing well? So I think there are 3 or 4 parts to this answer. One, COVID is impacting profits for 1 year, not for 10 years. So I think we need to understand that. And if a business does not make money for 1 year, it reduces the fair value of the business by maybe 5 or 10% and no more. So if stock markets fell 40%, then they will come back as markets realize that this is a short-term event and this will pass. So that is one thing. Second, as I said a moment back, that consumption, which is the main casualty of the current environment, is 2/3 of the economy, but is only 20% of the stock markets. How does the state of the economy impact a pharma company? How does it impact a software company? How does it impact a telecom or a refining company? How does it impact a metals company? So you would see that these are businesses which have variables which are not in the current state of the economy. So that is the second thing which people need to understand, that most of the retail shops, the airlines, the restaurants, the hotels, the gymnasiums that we see in pain, they are not listed. And even if they are listed, they are a very, very small percentage of the market. And for example, telecom pricing has been moving up and the consumption of telecom is going up. I mean, how many bytes of data would this Zoom session consume? So I think we need to look at the composition of the economy and the markets. The third factor at work here is the interest rates. And Warren Buffett said that interest rates act like gravity on stock prices. Interest rates have moved down sharply in the world and in India. The value of a business, the value of cash flows will go up as interest rates come down. So while profits themselves may be low, but the counter force is the higher value of the future profits because of the lower cost of capital. So I think these are 3 factors what you need to keep in mind when you look at these markets. So I would say, I would not like to comment on outside India, but in India, I don't think that there is a bubble in these markets. There could be individual sectors that are expensive, but if you look at India's aggregate market cap to GDP or a price to book value multiple, they are quite the key to figuring markets at times like these is not to focus on today's headlines, but to close your eyes and to imagine how will the headlines look like after 1 year. Right. Because the negative impact of COVID and all such events gets priced into the markets very quickly. And I think that is what is happening.
Right. Thank you, sir. Going to the third one, considering the level of volatility in other investment areas, sir, do you think investing in government bonds is a safer option to protect our capital?
Of course, government bonds are a very safe option. There is no denying that. But I mean, it is the right option for you if you want only safety and no returns. So, but I mean, bonds themselves and government bonds, even more so, will give you lower returns. So if you are looking for safety, I myself said that safe portion of your capital should be invested in bonds, and government bonds would be a very good option. But if you are looking for returns higher than what these bonds offer, then I think you will have to move to other asset classes.
Right, sir. Thank you, sir. The next one, sir. Do you think the current growth in the pharmaceutical companies will sustain after the wave of coronavirus is over? Or is it just a spike hoping for good profits with the release of vaccines for this virus?
See, I think the growth being referred to in this question refers to the stock prices and not to the business growth, because the sales of medicines have not done that well, because people have not been able to consult the doctors, and many non-essential surgeries have been postponed the world over. So if at all, I don't think the consumption of medicines would have moved up in this period. Uh, I think coming to stocks, these stocks have done well because, as is quite evident, the impact of COVID on businesses like these is minimal, and therefore they have done well in the recent times. And to see the recent price movements of the sector, you also have to understand that this sector has been a big underperformer over last 5 years. So many of these companies had fallen 60-70% compared to where they were 4 or 5 years back. And so the starting base of this sector was also quite low. I think this is a reasonable sector. This is a good sector to invest in. Indian companies are leaders in the world generic space. These are well-managed companies, strong balance sheet. But it is also a sector where you cannot take a very top-down view, because each company has different products, different strategies. So this is a sector which is at times hard to forecast future, because the US generic market depends a lot on the regulatory successes that you achieve and the molecules that you are able to launch. So I would say this is a good sector, and one can consider investing in this sector. Don't put a lot of money in one company. And I think given the variations or the differences or the risks across these companies, put a basket approach may be more suitable. And finally, I think I said earlier, focus on risk. So that means that don't expose your portfolio too much to any one set of companies. So diversifying across few sectors at least, I think, is always a good idea. Yes.
Right. Thank you, sir. Proceeding to the next one, it has been asked that would it be wise to invest only in one secure company? We have blue chip companies who have excellent net worth and liquidity, so there is very less possibility of them to collapse. So do you think the profit margins would be higher if we invest that way?
See, you are looking for a good investment and not a good business. So I think we need to differentiate between the two. If you overpay for a good business, it may turn out to be a bad investment. And if you buy an average business or not a great business at a very attractive price, it may actually turn out to be a better investment. So I don't think a great company, a good company, a blue chip company at any price will be a good investment. You need to be very mindful of that. And also please remember that technology is disrupting many established business models. So a blue chip of a current blue chip may not remain a blue chip after 10 years. So as I said, investing is it is a field where it is very easy to ask questions, but it is very tough to give answers. One, because we don't know how the future will look like. And two, these opinions can vary from individual to individual.
Right. Thank you, sir. The next one we have is it a good time to invest liquid in crypto coin?
So I think this is something that I should pass, because as you know, Lakshman had told Sita not to cross the Lakshman Rekha, and she crossed it, and you know what happened. So I think I should stick to my circle of core competence, and crypto coin is beyond my understanding, so let me not cross this circle of competence.
Okay, sir. Thank you. The next one we have is, do you feel that the market as a whole is retracting back to the normal levels, or is the index a bit manipulative of the fact that few high index weightage companies have done quite well?
So I don't think if few high index companies do well, index weightage companies do well, I don't think you should call that manipulative. I mean, if at all, someone could manipulate a small company and not a large company. So I think a better way to phrase that question would be that the index has been driven in the recent times by few companies, and I think that's a fair point. But these are phases, these are cycles in the markets, and until 2 years back, it was the small and mid caps which were doing much better than the larger companies. And I think the recent times, the small mid caps have not done well. The larger companies have done well. So I don't think we should be overly concerned about these phases in the markets. These companies keep on coming in and going out of favor, whether they are across sectors or across large, mid, and small caps. I think this will also pass. I think this phase will also pass, where very few companies have driven index returns.
Okay, sir. Thank you. Sir, one of our participants has asked your opinion on the suspension of IBC for a year.
So I think let me not comment on that again, because see, these are issues on which we have very little understanding of. And so I always respect the opinion of experts who have taken this decision. So let us leave it at that. And because people like you and me we don't have all the facts and the challenges to be able to opine on this.
Okay, sir. Thank you. And proceeding to the last question that we have, the question is, can the current volatility be attributed to the gigantic inflow of retail traders? Also, how do institutional investors such as your company brace against these?
See, equities are always volatile. And if equities are not volatile, then, I mean, imagine a world where equities are not volatile, then what would happen? We would invest all our wealth in equities. Why would you invest in bonds? So I don't think you can take volatility away from equity markets. The successful investor looks beyond the near-term volatility, and he will try and seek opportunity because of this volatility. It is true that the share of retail investors in stock market trading volumes has gone up by I think 5 to 10% in last 6 months. What is driving this? I don't know. It could be a multitude of factors. It could be post-COVID, the small mid caps fell to very low levels, and they have given very handsome returns from those levels. So it could have attracted large number of players. Interest rates are extremely low, so people are attracted towards equities. People are sitting at home and seeking they have spare time, so they think, and you can trade online. So I think it could be some or all of these factors which have led to this development. But the delivery volumes have gone down in the marketplace. So most of these volumes by retailers are probably speculative in nature. And I feel that one should be careful when you take that approach to investing in equities, because in my judgment, while there are definitely some very smart, successful investors, but a majority of investors who have accessed the markets directly have lost money. The reason why that happens is retail investors focus maximum on direction, on momentum of the markets. And whatever are the fastest moving, the most popular investments, that is where bulk of retail investments are focused on. So in 99 it was tech, in 2008 it was infrastructure, in 2013-14 it was pharma, in 2015-16 I think it was small mid caps. And you can see that whatever sectors go up very sharply, at some point of time they tend to disappoint. So I would say there is nothing wrong in accessing the markets on your own. But as I said earlier, one cycle in the markets is 6, 8, 10 years. And unless you have right understanding, either don't invest on your own, or if you are investing, start with very small amounts and never invest with borrowed money or in stock or futures options.
Right, sir. Thank you. So I'm so sorry, but there's one last question that's come up. The question is, after the RBI announced the extension of moratorium on term loans by 3 months, share price of the banking and financial sectors are falling. So what are your comments on this statement?
So I think the concern is that if you extend the moratorium, if people don't pay an EMI for 3 months or 6 months, then the chances of that loan going bad do increase. And I think that is why the banking stocks have not done well. And I think that's a fair point that is being made. As I said, in my judgment, the large banks should not be much impacted by the current economic environment. It is the smaller banks and the NBFCs that will undergo more pain. I think one more factor why banks have not done as well, apart from the current environment and valuations in some cases, I think the supply of new equity issuances by banks is very large. And the regulator is also encouraging the banks to raise more capital to prepare for a bad day. So many of the large banks have raised or are endeavoring to raise equity capital. So the supply of new shares is quite large, and I think that is also an overhang on the prices of these banks.
Great. Thank you, sir. Back to you, Pamona.
Yes, okay. So that was indeed quite insightful. With this, we have reached the end of it. And I would like to thank Prashant, sir, for taking out time on a Sunday evening. I really hope, sir, that you have enjoyed as much as we all have. And I'm sure we've all learned a lot of new things. So I wish we could have this session in our college, but unfortunately it had to be online. But nonetheless, it was so engaging. And thank you so much for your time, sir.
Pleasure.
Also, I would like to thank Suwaiba ma'am for joining us. It was very encouraging, ma'am. And thanks to Ruchi ma'am for supporting us throughout, showing us how this online thing works and everything. Thank you, ma'am. And thanks to Team Commercium, Ananya, the chairperson, Ameya and Pratham, the vice chairpersons, Robin and Shino for the creators, Abin and Shreyas for admin, and Donna and Jyotika for PR. Thank you so much. Thanks to the participants.
Thank you, Pamona.
Thank you, ma'am. Thanks. I really hope the participants have enjoyed it, and I hope to see you guys soon. Happy Friendship Day to everybody.
Thank you.
Thank you, Team Commercium.